So the last day of the first quarter of trading on the ASX 200, and it's hardly moved a peep. I'm joined by James Kirby from Eureka Report. James, how much action have we seen so far on the market?
Hi Jackson. Actually, you've seen more action than is obvious from the screen. When you look and you see the figures for the quarter, it says, well, we're about 1% up since the 1st of January on the ASX 200. If you throw in dividends, it's up about 2%. However, if you look at the screen, you see it's like a V. So we actually dropped about 4% from the start of the year to early February, and we've recovered it all. So it's actually a considerably better picture than you might expect just looking at the flat figures.
Is this surprising though, given the market went up by so much last year?
Oh, look, it's inevitably going to be volatile. We saw 20% in the previous calendar year. We saw 20% in the year before that. We saw the banks really driving things, the miners not driving things. And that is very much the case in this first quarter as well. How it'll pan out in the months ahead, I'm not sure, except to say that the consensus is that we should still breach, 10% or more in this calendar year would not be surprising, and certainly would seem to be feasible looking at the earnings, looking at the economic conditions underneath the market.
But there have been some worrying headwinds. We've had the iron ore price, tumbling quite sharply a few weeks ago. Some would say that the banks are as high priced as they ever could possibly be. So there are some things that people would be worried about, wouldn't they, looking at these numbers? Yeah,
there's always plenty to be worried about. And iron ore price did come off, and that was coming for a long time. The miners were waiting for it. It did actually happen. The banks themselves on a value metric aren't in any way stretched, actually. Some of the banks, ANZ is actually in the value zone. That might surprise people because you think that they have done so well so far, but the yields they're paying, of course, very high. Still the highest in the market. The market itself paying about 4.25%, 4.5% dividend yield across the board, but the bank's paying more than that, 5% and higher.
One other thing which I think is quite fascinating is looking at everything old is new again. We've had a couple of years where emerging markets like China and Asia have been absolutely booming, and the US and Europe were quite moribund. That's completely flipped around, hasn't it?
It has flipped around, and it's interesting because normally at a time of recovery you would say, well, the Western world will do whatever, and then the emerging markets will do a multiplier of that, and that's not the case this time. So there is some serious structural changes happening. Obviously part of it is the US recovering on several fronts, the US energy prices kicking in there, and really that's quite important in the overall picture. And then you have the first signs of recovery in Europe, and of course paradoxically it's the banks that start to kick first every time an economy recovers, and it's the case in Europe too.
James Kirby from Eureka Report, thank you very much.
Thanks, Jackson.